Hi everyone, welcome back to another episode of Beyond the Markets. It was another crazy week where we saw a volatile market with a steep drop on Friday. Why did this happen? Well, one of the things is probably Trump, who's now considering more limited tariff plans. Are Trump's tariff plans taking a softer turn? The former president, who has long pushed for strong reciprocal tariffs, is now considering a more measured approach. For months, Donald Trump has been vocal about implementing strict reciprocal tariffs, aiming to equalize US import duties with those of other countries. Originally, he planned to roll these out on April 2nd, but now his administration is signaling a more flexible approach. However, in a recent Newsmax interview, Trump suggested he may be more lenient, acknowledging that strict reciprocity could be very tough for people, and his team is now considering exemptions for certain nations and industries. Instead of taxing both finished vehicles and auto parts, the administration is now focusing only on finished cars coming into the US. The goal of this policy? Encouraging final car assembly in the US rather than relying on Mexico and Canada. So who are the winners of this new tariff? Well, the US auto industry. The winners are the US-based auto manufacturers like Ford and GM, which could see increased domestic production. The losers are pretty much all foreign car brands, including the Chinese car brands like BYD, but also Toyota, Volkswagen and BMW. When we take a look at these trading partners, so Mexico, Canada, Europe and all others, we see some people that think tariffs are a good idea for the US, but they understand that some of these will destroy real economies close to the US. As such, the White House may erase restrictions for key partners, but tougher tariffs could come later if these countries retaliate. So, will Trump's more lenient approach hold, or is this just a temporary strategy? That remains to be seen. In addition, most US car makers rely on imported parts, even if final assembly happens in the US. Industry experts predict car prices will rise 11 to 12% by May, once current inventory runs out. Inflation remains a major concern for Trump's administration, even though he rarely talks about it publicly. The reason why he doesn't talk about it is obviously due to the fact that it's quite an issue for his voters. And on Friday we had once again bad numbers that are showing that inflation might be heating up again, which caused the S&P to drop over 2%. When we take a look at the industry response and potential consequences, we can see that the American Automotive Policy Council, representing GM, Ford and Jeep, warned that price hikes are almost inevitable. It's unclear how Trump could punish automakers for raising prices. Automakers depend on federal regulators for critical approvals, raising concerns about potential government pressure. When we take a look at the bigger picture, we can see that oil and gas companies have warned that tariffs could drive up gasoline prices, especially in the Midwest. Trump has been cautious about tariffs on energy, likely due to concerns over gas prices, because these play a major part in driving up inflation. Another story we saw is that Hezbollah accused Israel of breaking ceasefire promises. Now is the question, what's really happening? Tensions are rising again in the Middle East. Hezbollah has accused Israel of violating ceasefire agreements by launching strikes during what was supposed to be a period of calm. But what exactly is happening on the ground? Are we looking at another dangerous escalation? The Middle East is a critical hub for oil production. If the conflict between Israel and Hezbollah worsens, it could spill over into Lebanon, Syria or even Iran. Major players in regional politics. Brent crude prices could spike, leading to higher fuel costs globally. Industries relying on cheap oil, like airlines, logistics, and manufacturing, could as such suffer from this. Countries depending on oil imports, like China and India, might face some inflationary pressure, but inflationary pressures will be seen all over the world if this happens. When we take a look, we can see that markets have already seen Brent crude futures react to the news, and energy traders are closely watching how this situation unfolds. Investors tend to flee to safety during geopolitical crises. Whenever conflicts erupt in the Middle East, we usually see gold prices rise as investors hedge against uncertainty, the US dollar strengthens as global safe haven currency, stocks decline, particularly in emerging markets and sectors vulnerable to high oil prices. Companies that could benefit from these tensions include defense contractors like Lockheed Martin, Raytheon, Northrop Grumman, and obviously all the European companies, which has already been booming. And this is due to the fact that governments might spend military spending further. Energy companies like ExxonMobil and Chevron will also benefit due to rising oil prices. On the flip side, sectors that will probably take a hit are airlines and shipping companies because of higher fuel costs, consumer goods and tech because if inflation spikes, consumer spending weakens in general. For now, the key things to watch are: will Israel escalate further? Will Hezbollah retaliate in a way that provokes a full-scale war? Which I doubt, as Hezbollah is already very weak due to strikes by Israel a few months ago. And will oil prices spike beyond $100 per barrel? That's a big one to watch. Elon Musk's radical government experiment. Will it work? That's the big question. Elon Musk is no stranger to disrupting industries. He's transformed electric vehicles, space travel, and even social media. But now, he's taking on something much bigger: the entire US federal government. Through his newly formed Department of Government Efficiency, also known as DOGE, Musk is applying his move fast and break things approach to federal bureaucracy. But can government actually operate like a startup? More importantly, what does this mean for the global economy, financial markets, and even for Tesla stock itself? We have seen that Tesla stock has been crashing lately, and it doesn't seem like it will reverse soon. Doge was created with one mission: cut government inefficiency. The results? Well, the results are chaotic, unpredictable, and sometimes highly controversial. Just like Tesla's early days, Doge has already been hit with regulatory challenges and pushback. Courts are slowing down or blocking its actions, while federal employees are resisting rapid changes. But Musk's philosophy remains the same: if it doesn't work, we'll just put it back. Elon Musk has a long history of shaking things up, and it's worked before. For example, when Tesla ramped up production of the Model 3, it broke multiple labor and safety regulations along the way. The OSHA cited Tesla for 77 violations since 2008, and 80% of which were workplace safety issues. Furthermore, in August of 2024, a fatal electrocution incident at Gigafactory Nevada brought more scrutiny. Musk's high-risk, high-reward strategy paid off in the private sector, but can the same approach succeed in the government? We will look at the economic impact and how our global markets are reacting on all this. When we take a look at stock market volatility, we can see that investors are uncertain about how deep Musk's cuts will go. Tesla's own stock is fluctuating as Doge faces court battles and political scrutiny. When we take a look at the federal deficit and spending cuts, Doge claims to have saved around $130 billion so far. But that's just a fraction of the US $34 trillion in national debt. When we take a look at the impact of trade and tariffs, we can see that Doge's influence, combined with Trump-era tariffs, is rattling global supply chains. Industries dependent on federal contracts, like aerospace, defense, and tech, are watching it closely. One big question yet to find answer for is, can Doge actually work? Musk's approach thrives in tech, where agility and innovation drive success, but government spending obviously operates differently. Governments are built on laws, checks, and balances. Moving too fast without proper oversight can lead to a multitude of issues, like legal battles, but also market instability, which we have seen recently, and unattended economic fallout. We will see what ends up happening. But in my opinion, I think Doge is actually a great innovation, and hopefully Elon Musk will be able to do what many think is impossible. That was it for the news. Now let's move on to the charts. Before we start looking at the charts, we look at the straddle price each week and discuss if selling it last week would have been profitable if held till expiration. The straddle price gives us a pretty accurate estimation of what the market makers want to receive to sell the current volatility, and as such show how wide they expect the market to go up or down at most. If you would have opened a 7 days till expiration short straddle last week, you would have generated a profit of $243 this week. But it could have been a lot more. Before the significant sell-off on Friday, you would have made close to $750 on the short straddle, which would have been over 50%. When we take a look at the S&P 500 ETF, SPY, we can see that it had a rough week. The SPY closed the week down close to 1.5%, closing at around $555.66 per share and reaching a high of $576.41 and a low of $555.07 respectively. It was another volatile week, with the week starting very strong, but the market starts selling off on an inflation scare on Friday after higher than expected inflation numbers were reported. The straddle this week is priced at $14.08, which is almost $300 more expensive than last week. Once again, selling the straddle could potentially be very profitable this week, as significant volatility remains to be priced in. The VIX rose close to 16% on Friday and is currently sitting at around 21.66, which is an elevated level. This gives us an interval between 541.58 and 569.74 for the straddle to be profitable. This is more than a 28-point spread, which is quite significant, showing the expected volatility. Nonetheless, it's important to remain cautious because we are in a very volatile market, and it could very well be that the VIX spikes further. Max Pain currently sits at around 570 for the expiration next Friday, which is the same as last week. Something to be noted is that the Max Pain strikes lays very close to the upper hand of the break-even of the straddle. This signals that the 570 level might be quite attractive for market makers. The Nasdaq closed the week down 2.4%, reaching 19.28k. The NDX reached a high of 20.29k and a low of 19.24k this week. The Nasdaq closed the week at its lowest level year to date. When we look at the Russell 2000 or the small cap index, we can see that the Russell closed the week down 1.8%, reaching 2.04k. Small cap index is still showing some more consolidation behavior compared to the Nasdaq and the S&P, which are clearly selling off. It reached a high of 2.13k and a low of 2.03k this week. That was it for this week's Beyond the Markets weekly recap. Make sure you like and subscribe to not miss out on next week's content. Maybe take a look at the straddle price, because selling it could be very interesting if you think volatility will compress a little. See you next time.